On this episode of the Tristian Clunis Real Estate Podcast, we brought on a special guest, Sean Humphries from the DLC team, to talk about everything related to financing for first-time buyers and the stress test. Make sure you hit the like and subscribe button, and let's get into the show. What's up, everyone? Tristian Clunis here, and welcome to the Tristian Clunis Real Estate Podcast Show. I'm your host, Tristian Clunis, of course, and I have my co-host slash, he's kind of like my protege slash, we do this every single episode. We have Wes Hype here. Wes Hype, what's up, bro?
Ask Clunis question number one. Did we add the word show to the end to just make the logo longer?
The Tristian Clunis Real Estate Podcast Show.
Why?
I don't understand. I don't know, but I feel like it works.
I'm pretty sure it's a podcast, and like we don't need the show.
I feel like the show's necessary. You guys, we're gonna do a comments. Please comment below. Let us know. We're gonna do it in Instagram and also on YouTube if we should be adding in the Tristian Clunis Real Estate Podcast Show. Or we're gonna let you know.
I can just answer the question now. No.
Moving on. He's not the captain now. I made it very clear. This is episode 5. I'm asking the co-captain.
Yeah. I'm glad you asked me that. 5. Number 5. Yep. Yes, sir.
This
number
is
5.
episode number 5. We've been moving, bro. And just for those that don't know, we are on YouTube now, and I'm extremely, extremely happy to say that because I've been looking to do this for years, and we're on live, man. We're ready to go. We're on YouTube.
We're clicking. We're moving. We're shaking.
Episode is out. Please go watch it. We have little clips as well if you want to just take it in bite-sized pieces.
Yeah.
What else, Wesley?
Whatever.
I
don't know why you keep asking me questions.
Wait, what?
I mean, like, I could just ask you the questions and keep this moving, but you can ask me questions if you like. Go ahead.
Go ahead, Wesley. Take it out. Take it over, Wesley.
Hey, Tris, I got an idea.
Wait, what?
Thanks for letting me take over. Since it's the
Not
fifth
that I'm giving
episode,
him permission to. Sorry, go ahead.
Thanks.
Yeah.
Since it's the 5th episode, why don't we mix it up a little? Why don't we do something different for the 5th episode? Why don't we introduce a guest, perhaps?
Hey, Wesley.
Maybe.
Good idea. I'm glad I came up with that idea, guys. How about we introduce a guest?
What guest do you have in mind, Tris?
Well, guess what? See that? You see the guess what to the get? Anyways.
That was terrible.
No, it was awesome.
Go ahead.
We have, because we've been getting a lot of questions on Ask Clunis, which we love. Please bring the questions. Keep them coming. But it seems to be the same questions that come up for the most part.
Yeah, a lot of times it is one sector that is asking majority of the questions, as they should.
Well, of course, 100%. And I'm glad that they're bringing it to us, which is awesome.
Definitely.
But it's mainly on first-time buyers.
Correct.
First-time buyers, and of course, if we were going to even be even more specific, it's on financing, getting a mortgage, qualifying for a mortgage, because as I always say, that is the most important part of the whole process.
It's a prerequisite.
I would say so. Yeah. So, guess what? We have a great and special guest on our show today. We got my guy here. Just to kind of give you a little bit of an intro. I'm for those that don't know, I'm with Royal LePage Signature, which is a huge brand in the real estate industry. They are one of the top brands in Canada. And we have a brokerage that with multiple offices. We have 3 offices across the GTA. And within that brokerage, we have a financial department. So we have our mortgage department, and it is the Dominion Lending Centers, which is also known as Edge Financial, specifically.
That's right. Yeah.
Yes. And within our office and within our brokerage, we have one guy that stands out when it comes to the financial side for first-time buyers. He does seminars regularly. Like, I think you're at once a month now?
Yeah, twice a month.
Twice a month.
Yeah, it's
Wes,
too much.
what are we doing? He does twice a month, which is insane. So,
Sounds like more work for me.
and it's all focused on first-time buyers. We're gonna be talking about that as well. We're gonna be doing our own seminar where we're gonna have Sean on it as well.
Yeah.
We do this. Sorry, he does this in his sleep. First-time buyers, he knows everything related to it. There's nothing that you're going to ask him that he's going to be surprised of, especially when it comes to the financial side. So we have my friend and colleague, Sean Humphries, on the show.
Thanks for having me. I'm so excited to be guest number 1.
Guest number
this
1.
Is huge.
I would say so.
Yeah, thank you so much.
Yeah, no, it makes perfect sense.
Yeah.
I'm excited to have you, man.
Well, there's lots of financial questions. Like every first-time home buyers, like how do I get qualified? Like what is that process like? And so it's just a really natural thing to be able to answer those questions. And you've said, oh, you can handle anything. I'm excited to see what the
We're
Ask
gonna
Clunis.
throw some stuff at. We're gonna test. You better believe.
Quiz
We're going to
question
test
number
you
one.
out.
I'm sweating a little bit here.
The bow tie's gonna be like hanging by the time we're done
my
here.
jacket off.
It's like the Hot Ones podcast in the middle.
Exactly. You might as well.
You're gonna slide
Actually,
over.
why don't we start with one of the questions from our Ask Clunis audience? Because I think it's pretty like A1 basic. The first question I have here is, what are the minimum requirements to qualify for a mortgage, credit score, etc.? Would you say that's like the beginning, like the minimum requirements?
Yeah, I think, well, in terms of credit score, like it honestly depends on your down payment that you have. So if you have a minimum down payment, so less than 20% of the purchase price, they are a little bit more strict on what your credit score needs to be. So I always say like 680 is really the credit score that you want to be above. Anything above that, you're going to get approved for the maximum mortgage amount. You can go below that if you have a bit bigger of a down payment and there's other good things about your mortgage qualification, like you've got a good job, you've got a big down payment, like there is some flexibility in that. And we also have lenders that will who specialize in people with lower down payments or lower credit scores. So, but you need to have a bigger down payment. So without the down payment, your credit score needs to be a little higher, 680 and above. And some, it's the insurers that, your CMHC, if you're familiar with that, and there's two other private brands as well. They look at your credit. Like that's one of the big things that they want to make sure that is above 680. Now the average Canadian is up closer to like 730.
Okay.
And first-time home buyers often have higher credit scores than that because they're so worried about, oh my God, like I want to buy a home, like I better make sure I'm paying my credit card, and
When you're thinking that from the second you think about buying a home, now you're starting to watch your credit balances. Exactly. You're starting to watch, am I paying my phone bill? Because as you're probably going to mention, like people even get confused that your phone bill can affect your credit card your credit score as well.
One of those things that's on there. Like if you've got, you've decided that you're going to stand up to Bell or TELUS. And, like I'm not going to pay.
No, people.
I love the way you put that. Yeah.
People like that.
Definitely.
Yeah. Like I'm not going to do it, right?
People that like really end up just shooting themselves in the foot trying to take a stand on something.
For sure.
You're not getting my $50. Well,
that's it.
Who's that affecting? Is that affecting you?
Yeah.
Or Bell more?
Yeah. I've definitely heard those stories.
100%.
Bell's going to be fine with it.
No, I think the $50 Bell's gonna. Yeah, they'll be okay. I think so.
You mentioned CMHC. Why don't you just touch on what that is a little bit more?
Yeah, so it's the Canadian Mortgage and Housing Corporation, and so they provide insurance to people on your mortgage if you have less than a 20% down payment. So if you've got less than 20% down, you're going to pay an insurance premium on top of your mortgage. So if your mortgage is $500,000, your insurance premium might be another $10,000 after that, and you'd pay off a mortgage of $510,000.
Right.
If that makes sense.
And just to be clear, like I know when I first started in the business and I heard about CMHC and Genworth is another company that we use. People think that that's their insurance.
Yeah, no.
It's not the insurance, it's the insurance to the lender.
That's right. Yeah. Well, it's like insurance for everybody. So if you're buying a home and say the whole market starts to go down, it will be those people with less than 20% down, less equity that are going to start foreclosing on their homes first. They're going to default on their mortgages. And so say that's something across the board where tons of people are starting to default on their homes. It's going to be those likely first-time home buyers with less than 20% down. They're going to start defaulting first. So the default insurance helps lenders to it's insured. So if that does default, they're not losing their money. And so they're not losing their money. Everybody else isn't. And then the entire banking system is stronger because those banks aren't all of a sudden having this run of default. They're at least getting the top end of their mortgage portfolio insured, and so they don't have to worry about that.
And even in an economy, like for those that don't know, like if the real estate market starts to default, like default, that affects everybody. Not just if you whether you own a home or don't own a home. That affects our whole economy as a whole, right? So
Exactly. So it's huge. So it's there to protect everybody.
Yeah.
You know?
Yeah, I love the way that you put that because I was looking at it always like I'm Tristan's student here that's picking up as I go along with.
Can you say that one more time? I just want to make sure. I want to make sure. Sorry, camera on me, and then going to put the camera on Wesley. Go ahead and say that one more time, please.
So as far as the podcast goes, I'm the captain.
Wow, that's not what he was supposed to say.
In real
That's
estate,
not what he was supposed. Chris, that's not what he was supposed to say. No, do we have something? No, we don't have it. I was looking for a sound effect. That's fine. Go ahead.
Nah, but in real estate, I've been learning a lot through Tristan's 10 years in real estate, and I never we looked at it a lot from as the lender's insurance, but to hear it as everybody's insurance, you're 100% right. The real estate affecting all markets and the CMHC protecting the banking system. It just helps everybody, not just the lender and not just the client, right?
Yeah.
Very true.
Follow-up question. Yeah, I do. It's kind of a related question. Does a higher credit score mean a better mortgage rate?
It unless it's 680, if it's like you're getting the same credit score at 890 as you're getting in the same mortgage rate at 890 as you would at 680.
Okay.
Interesting.
Yeah. So if it's with the bank and you qualify for like the minimum, there's no like, oh, you've got a 900 credit score, a perfect score.
Right.
You're not getting a better
Interest
mortgage
rate.
rate
Got you.
than somebody at 700. Like it's like once you hit that threshold,
You're good.
everybody's treated the same.
Got you.
Makes sense.
Yeah. And with everything that's happening with the pandemic and the rates dropping, do you see the rates increasing at anytime soon?
Well, they went way down for a while there, and now they've kind of crept back up to like over 2%. Like we're like well under 2% for a lot of the interest rates for like our fixed rates. Now they're up like, under 2.5, but still really low compared to like historical normal of like what, they say like, I used to give the advice like, hey, if you can get an interest rate under 3%, like you're laughing.
100%.
Like, it's great.
Well, they talk about it all the time. If you talk to the older generation, our parents and all that, they're like, yeah, I got a great interest rate at 18%. What? Obviously, this was years ago, right? 18%, 11%. Like that was a regular thing. Obviously, for us, we're like, buddy, what? 18%? That's a credit card.
Yeah.
Right? But like,
Crazy.
so 3%
3% was great.
is amazing.
Yeah. But now everybody's acclimatized to like 2%.
Right.
And so like 3% is like crazy for
Right,
people. Like
right.
they could never imagine that. I mean, 14 years ago, I bought my house. I got over 5%.
Right.
And I got a great deal.
Yeah. You're like, you thought you were stealing the house.
This is
Yeah.
amazing.
Like the bank is going to lose money on this situation.
Exactly. Yeah.
But obviously that percentage represented a much lower amount than we're talking about now. House prices 14 years ago in comparison to today.
And I had a 40-year amortization.
Oh, wow.
So, which
Wow.
Does that exist now?
does not exist
No,
anymore.
30 years is
Grandfather
With
plans?
the minimum down payment at that time, I could do like with like 5% down, I could do 40-year amortization.
Wow.
So I would have been paying it off until I was like in my late 60s at that pace.
That's awesome.
You asked a question about credit, like, if you have a higher credit score, does that make a difference? I had this one client one time that he came to me, he had a great job,
Right.
he had a really good down payment. He said, and I said, well, just ask, how's your credit? He's like, Sean, I'm ready. I've canceled all my credit cards. I don't have a car payment. I don't have any credit to my name whatsoever. I'm like, I can't help you. He had nothing.
He thought he was coming with
He
like
thought he was
this.
like,
I figured it all out.
I'm ready.
Ready to rock.
Ready to go. God, I've canceled everything.
Yeah.
Yeah, I was thinking this sounds terrible.
It is terrible. So, you lenders want to see that you've got established credit, that
Right.
you've got a history of making those payments,
Right.
and you can take on more. They don't want to see that you don't have any history or you don't have anything active, because that's like a major red flag for them.
So for those of you that are closing down credit cards, you recommend not to be doing that.
You
Pay
don't-
them
yeah.
off.
Pay them off for sure.
Pay them off for sure.
Yeah.
Try not to keep a balance. That's great.
Yeah.
But closing them and getting rid
Closing
of that
them
history
Doesn't help.
becomes
you.
an issue.
Yeah.
Correct.
Your older credit cards do more work for your credit
Right.
score. The longer the history helps to strengthen your credit file.
Right.
You want to have a thick credit score, as they say. Like, because they used to have like stacks of paper in a folder.
Right.
Like a thick credit score means
like
you've
that
got
example.
lots of credit
Gotcha.
history.
They have lots of examples to see that. Okay, he pays on time. He pays in full.
Yeah.
They want those examples.
I actually got a personal question. I got an email the other day, which like I started like freaking out. I had a Hudson Bay Capital One card that they're just like out of nowhere. They're just like, yeah, we're canceling your account. You have until this day to pay it off, which is like I think a year down the line or whatever. So I started like freaking out. Like I'm making my payments on time. I have it automated. Like what's going on? Why are you canceling the card? What happened is Capital One and Hudson Bay dissolved their relationship. So there's no longer a Capital One Hudson Bay card. How does that work for my credit? Does that affect it in any way, shape, or form?
It would have like a minimal impact on your credit for like a short period of time. So say that you did cancel your card, like you did it. I'm not sure how it would work if the lender cancels it, but for you, like anything is recoverable. Like, say you cancel it 2-3 months later, it really has no effect on your overall score. If you've got like other credit accounts and a thick credit score, credit portfolio, you'd be fine. Like there's not really going to be something that's going to affect you long term.
Okay. I was mad. Question. I was like, how dare you?
Did you say that to them? Did you send that? Who are you not daring?
The email. When the email came through, how dare you?
You must have been outraged.
I was livid. But no, but it kind of threw me off. I was like, I've always heard don't cancel your credit cards. And I'm like, wait, what if they did it and not to know? Like obviously, if they canceled it for non-payment or something, that would be terrible.
Yeah, that's different.
But if they did it just because I was like, I don't know how that fares. I want to start with I want to kind of circle back.
Okay.
I do have more questions, but I think we're going even deeper into the realm of now we're getting into some people asking some very specific questions. But if they come to you first and they're just asking like let's even go before like how do I qualify for a mortgage? If they just come and ask like where do I begin?
Yeah.
What would you suggest to someone?
That's a great question. That's the reason why we want to do this podcast episode. Because originally, as I said to you before, we're going to make this all first-time buyer, the whole process. But I think that focusing on the financial side of things was very, very important. Give it the time, give it the minutes. Let's focus on this and then move on from there. But if we could walk through that process, I would say, and some people. It depends on who you're asking. Some people will say go to the bank first or go to a mortgage broker first. I usually say go to an agent, a real estate agent first, because I just imagine that for the most part, people don't just have that relationship, especially if you're a first-time buyer with a mortgage broker.
Definitely.
Unless it's a friend or a family member or,
Yeah. The majority of people have a real estate agent that they know. They don't know who to talk to.
Exactly.
Yeah.
Do you have your face on any sign, any bus stops or?
Not on purpose. No.
That's awesome.
Yeah, you see the realtors tend to do a little bit different advertising in that realm.
Yeah, you don't see that many
mortgage brokers on fridge magnets and that sort of thing.
You don't. But yeah, the reason why I say that is obviously go to a mortgage real estate agent first. Have the real estate agent bring you to a mortgage broker or to your bank. I always recommend a mortgage broker. I mean, we're going to touch on a bunch of things, but even if you can just tell the differences between the two, going to a mortgage broker or going to your TD or your Scotia or whichever big bank that you're with.
Yeah, I mean, I think we all grew up, seeing all the bank commercials and seeing like, we could probably name, all the
top
tag
5. Yeah.
for the banks, right? Like just like it's ingrained in being Canadian. Like there's top 5 banks. It's where I went. I took my passbook when I was a kid, and that's where I banked, right?
I've been with TD since I've been with TD since I was like in grade 5.
Yeah,
which
same.
Is I'm crazy.
Yeah, I was with TD, so I had the same example. I was with TD since I'd been there like 15 years or something.
Right.
And I thought, okay, I always heard like you have a good relationship with your bank, they're gonna be able to
take care of you.
Things.
Yeah,
of
course.
And so I had like next to no money, so I'm probably not as big of a shooter as I thought I was.
Yeah.
But I go into like the local branch, right? And like, here's my passbook. Right? And I walk in and I say, I've been with the bank sitting with the guy in the back, right? He's across his table like this, and he's got his, he's leaned back like this.
Yeah.
And I say, I've been with the bank for 15 years. What's a guy like me gonna get on a mortgage rate? And he literally pointed to the wall, the sign on the wall, and said, "That's your mortgage rate." And I was like, heartbroken.
Yep.
Yeah.
I'm like,
You thought
but
that they're going to go into a back room and set you up, say, oh, you know,
come with me. You know, we're gonna help you out.
Right.
a
You want
little
the
bit
nicer
here.
couch.
right.
Exactly.
been
The
with us
nice green
forever.
couch.
Yeah, that green one that's in that couch.
I've yet to see that.
I haven't seen the couch.
I've not seen that couch yet. Not even not at any branch.
I made a lot
Couch.
of large deposits, and they've yet to sit me on the couch.
No, eh?
Not once.
I'm dying to sit on the couch.
It's in the lobby in some.
Oh, yeah?
places. Yeah, the
look
downtown
for it one day.
locations. Like at a bigger location, there's like several of them you can go in.
I'm gonna
At
demand
least
the
there
couch
was. I mean, I don't go.
Maybe
to a lot
we're
of
going to
branches.
smaller
To the wrong
branches.
ones,
I guess,
yeah.
the wrong branches.
Next time I walk up to Teller and be like, I can't talk to you until you sit me in the couch.
Fair enough. They're probably going to tell you get out. No problem. Sorry, go ahead.
Like, next.
Go ahead, Sean.
next.
Yeah, right. Just keep it moving. Next, exactly, right?
Yeah.
Go ahead.
So I was heartbroken, and like, you know, I ended up going, and I said to my guy that place I was working was like the financial VP of finance or something. I
Right.
said, like, you know, I just had this experience at the bank. He's like, you know what, my friend's a mortgage broker. You know, he works with like 40 different lenders. He can help you out. And it actually ends up, I don't know if you know Alan Cadell, but it was it was Alan. And
Wow.
so, you know, I've known Alan that long. And now I'm in the brokerage where he runs the team.
Wow.
Okay.
But anyway, he was able to, and now I'm a mortgage broker. I work with about 40 different lenders, including some of the big banks, some credit unions, some mortgage finance companies. I call it like a dating service for mortgages. You know?
Okay.
So, like, you know, it's my job to find the right mortgage for my clients.
Right.
And then on the flip side, find the right clients for those lenders and understand what their requirements are and what they will or won't do. You know, a portion of that is obviously rate, but then there's also just the fit in terms of like, you know, what they do for a living, how they make their money. So, you know, at the end of the day, I get paid a finder's fee directly from the lender, and it's a free service for the buyers.
Nice.
So they don't have to pay anything. I don't walk in like, here's my bill at the end.
Right.
It's all included in the service, and I can often do it at a better rate than they get just walking into a branch.
I want to just stress that because I think that people think that, you know, if you go with a mortgage broker, you're going to have to pay them, right?
Yeah.
So, just to make sure that we're clear for all the people that are watching, the mortgage broker gets paid by the lender. Same thing for a real estate agent. We're going to touch on that on another episode, but the real estate agent that's working on your behalf as a buyer gets paid by the seller. So you don't pay the real estate commissions for your agent if you're a buyer. The seller pays it. So just want to make sure that that's clear.
Yeah.
And just to add on to that, if you're paying your mortgage broker or your real estate agent, something is wrong. If you're going into the what do you call it, the safe in your house and handing out cash, there's probably something that's not above board happening.
Well, let me clarify that. In certain situations, especially, and you could probably clarify it more because I think it handles more on your side. It happens more on your side, where a mortgage broker will charge a fee because a deal may be very, you know, on those more complicated sides where the mortgage broker is doing a lot more and not getting paid from the lender.
That's right.
That's when they will normally collect the fee.
That's right. Yeah. So like private mortgages,
Right.
there's a fee. You know, these are like either private wealthy individuals or institutions that lend private money outside what the bank would do.
Right.
But there are solutions for like what we call B lenders or alternative lenders where there would be a fee that would be charged, but it's for people that maybe don't show as much income as they actually make, like being self-employed, realtors, mortgage brokers, you know, lots of people don't show as much money as what they maybe actually make.
Taxes.
And so, for tax purposes, right? So instead of paying more tax, they would rather pay a fee and maybe a little bit higher of a rate. So there are those situations, and specifically like if somebody's got poor credit, that might be a solution that might work for as well. But the majority of people who are buying with like, you know, a 10% down payment and they've got good jobs, they're not going to pay a fee for that.
Got you. Yeah, 'cause that's what kind of like was like a red flag in my mind. I'm like, I heard people like, I can get you a mortgage, just give me X amount of dollars and it can get done.
There's
you're walking in.
It's a gray area for sure. Depending on the scenario.
You leave it all to me. You just sign right here. Like that's where the fee you don't want to pay.
Right. Fair enough.
Got you. Okay. So you want to get into some investment questions then? 'Cause I have so many questions.
Well, before we even get to the investment, so that's the first step is obviously I wanted you to make it clear the differences between a mortgage broker and going directly to your bank, you go directly to your bank. You're only going to be dealing with that term, the terms that they offer, the interest rate that they offer, everything that they offer, but you can't go outside of that. Essentially, they can
just
only
that
offer
one
you
product.
exactly
Like whatever
just
they
the product,
have.
exactly.
They've only got that one option.
Whereas a mortgage broker has access. For example, you would have access to 40 different lenders, plus I'm guessing private money and the whole nine, right?
Hundreds of different solutions
and different terms. Because I find that even just. I know I'm going to just touch on this a little bit. I'm touching a lot. The people focus a lot on interest rate. Interest. I want the lowest interest rate. But for the most part, or usually, I would say terms are extremely important.
Sure.
Because if you're going with the lowest interest rate, but then it's going to be hell for you to get out of your mortgage for whatever reason, things change. 2-3 years down the line, you may need to relocate or whatever the case may be. That interest rate sounds great at that initial stage, but then now the terms are going to be more important.
That's right. Yeah, no, you can, because a 5-year fixed rate is like the most popular mortgage. That's what kind of everybody seems to choose.
Right.
But at the big banks, the penalty to get out of that 5-year fixed rate mortgage is like, I don't know, eye-wateringly high. It's probably
that's a great term. Eye-watering.
It is excruciating. Yeah. Like people a $30,000 penalty is not unheard of to get out of. And I mean, it depends on the mortgage amount. It depends on how much time is left in the term. But in comparison to a variable mortgage, where the 5-year variable, where you're taking some risk in terms of the rate maybe going up or down, the penalty is like 3 months of interest, and so you might be talking like 5,000 or 6,000.
Very different
versus
from
30.
Yeah.
Right.
Yeah.
So 5 years ago, could you be sure that we'd all be sitting in this room and doing this? Right. It's just no predicting what life's gonna bring you. And that another mortgage broker that is in the industry, he says, life is variable. Your mortgage should be variable as well.
Right.
Now that sounds great, but that's not necessarily the right advice for everybody.
No, because some people, their situation can be a little more stable. So nobody has a crystal ball exactly how their life's going to end up in 5 years. But for the most part, they can consistently say, this is where I'm going to be in 5 years, where a fixed rate will be in their benefit.
Yeah, that's right. Yeah, and some of the competitors to the big banks, so we call them mortgage finance companies, they compete directly with the banks in terms of their mortgage product, the terms. They often have a lower penalty on that 5-year fixed mortgage
to be more competitive.
But there's getting over the I've always gone to this bank, I always feel like this is where I should bank, versus it's just a mortgage payment. It's just interest. It's just math. Like,
that's all it is.
It's just numbers.
There's no emotional attachment from the lenders to you.
Right.
The emotional attachment is all one way.
Yeah.
Right.
Yeah.
They do a good job in their marketing, making you think the other way, right?
I've cried after watching bank officials.
You shed a tear, right?
I was a little emotional during the hockey game, probably.
Yeah.
I want to
came out right after. Kind of related to the investment side of that. I guess one of the reasons that you might want to break your terms is is refinancing. Is that something that falls within that realm?
Yeah, so maybe you might want to do a home renovation. Maybe you've got some equity in the property. It seems like everybody's renovating their home right now.
I saw.
Oh my God, I had to stop watching.
Yeah, it will change your life.
It did, yeah.
Change your pockets.
Yeah. So, you've got these big plans, and like a great way to access that money is through a line of credit or just taking equity out of the property and financing that way. But most people don't have hundreds of thousands of dollars just sitting waiting for that. So that's one thing. People break up. People move for jobs. Like there's lots of different scenarios where, outside of just moving properties, where it might make sense to
family member gets sick. Yeah. Somebody's sick. Now you have to pay.
Life happens.
Things happen. Right?
So even just selling your house is technically breaking the terms of your mortgage.
You can port the mortgage, like portable. You can port the mortgage to another property. But it doesn't always make sense to do that. Like, you can port and then like blend where you like add another mortgage on top of the original mortgage. But it depends. Like it limits your movement, like what you can really do.
Yeah, I find that it just even with the clients I've worked with, they all not all, but some of them have the idea of, I'll just port my mortgage. I'll port my mortgage. I can count on my hand how many times that actually works out.
Yeah.
Where they're just now opening a new mortgage because it just didn't fit the criteria that your previous bank or lender or your previous contract.
Yeah.
You know what I mean? Because it's obviously you can still go to the same bank, but your contract changes. The agreement that you guys have changed. So
Well, and there's like, I mean, every situation is different, right?
Right.
Everybody's income is different. Everybody's new property they're buying is different. Porting is great when it works in that situation.
Right.
With interest rates being lower now, a lot of people are doing that math and deciding, well, if I pay the penalty, I'm actually ending up ahead by paying the penalty because I get a lower mortgage rate.
Right.
So, it depends. But it can be limiting, right? I'd rather pay a lower penalty and decide not to pay the penalty and port the mortgage because that made more sense than,
I agree.
you know.
I
so-
agree. So that's the first step. Obviously, you go to a real estate agent. Real estate agent, if he's a good real estate agent, he's going to bring you to a mortgage broker. Mortgage brokers, and obviously we just discussed the differences between the mortgage broker and going to your bank. Once you get to you now, so now that my client or whoever it is in front of you, what's the first step? Like, what are you doing now?
Yeah, I mean, I like to find out what their plan is, right?
Okay.
Like they have this, by the time they get to me,
Right.
they've pictured where they're going to be living,
A
who's gonna
castle
live there,
downtown Toronto.
Exactly.
Yeah. For only $400,000, of course.
Detached home.
Yeah.
right? So I like to find out how crazy people are. Like, how realistic is this idea? And just, finding out, what's the plan? Like,
Right.
what are you trying to do here? And then find out what the down payment is. Because I find that the down payment often is the limiting factor before income and before how much mortgage you'll qualify.
Or credit and all that. Yeah.
Credit, like, sometimes it's an easy conversation because, great, we've got a huge down payment. Okay, then we've got options. We can look at all sorts of different things. You can look at different, mortgage products and, how much do you want to put down?
Right.
But then starting to figure out, okay, have they set aside money for closing costs?
Right.
Yeah.
Because they might have the minimum down payment, but then there's land transfer tax and
Which is
there's
a
lawyer
hefty one,
fees, right? Like it can be it can be a lot.
Right.
And a huge down payment. Would you say that's 20% plus, or is that?
Yeah, I mean, like it's relative, right? So if you're buying a $1 million home, you're going to need at least 20% down. So you're going to need 200,000. That becomes like that 200,000. That's a lot of money, right?
Mhm.
But that's the least amount you need for $1 million plus.
Yeah.
So if you're looking, and the average home now is over $1 million in the GTA, or
Right.
at least in Toronto.
Yeah. For all home types. Yep.
And so looking at, okay, how much down payment do I have? Is that realistic? And some people come with prepared, like they know, okay, I'm going to need to have 20% down. Lots of people don't realize how much the land transfer tax is actually going to be.
When you get up to that number,
Yeah.
because the land transfer tax depends on your purchase price.
Yeah.
So it scales as your purchase price gets higher, the land transfer tax amount also goes, right? So
Yeah.
at $1 million, we're now that's a lot of
$1
money.
million in Toronto, because if you're buying in Toronto, you have the Toronto land transfer tax. You also have the Ontario land transfer
Right.
tax. It's double.
Right.
So you're looking at 50,000
a lot of
sometimes,
money.
right?
Yeah,
like,
for
and
sure.
not most people don't have that just
Extra.
yeah, ready to go.
Because exactly what you said, I find that people are just focused on the down payment. So I got to that $200,000. Let's use $1 million as our purchase price. $200,000. I got my down payment. I'm ready to rock.
Yeah.
No, we still have, another 50 minimum to go, right? With the
And
land
there's-
transfer tax.
And there's no way to roll those type of fees into your mortgage payment?
No,
that's
it's-
something you got to pay by closing.
Yeah, all due out of your pocket right away. So, and
Wowzers.
finding out, finding out, like, do you have help? Is mom and dad willing to help? The bank of mom and dad is a huge player right now, in especially the first-time home buyers market.
Yeah.
Is our mom and dad willing to give you some money for closing costs? Maybe that's $20,000, and that's what's going to help you to get into the property. Or, is anybody willing to co-sign? Maybe they're willing to come on and help with their income. Maybe don't quite have enough income to get the property that you want.
Right.
But, mom's still working and, she's still making good money. She can come on title and help you to get onto, the type of property that makes sense.
Someone actually asked me a question about that in the Ask Clunis section as well. They were asking if they have poor credit but good income, are they asset for cosign?
It depends how bad the credit is. Like if you've got like a, under 600 credit score, it probably doesn't make sense. They probably do more damage, than good.
Right.
So it really depends. It'd be if you've got, the idea is that they've got good credit and they've got good income, and that's kind of the perfect person you want to have to help you co-sign.
Gotcha.
Yeah. I had a guy today who I was talking to, and I'm like, these people are going to qualify for maybe like a $200,000 purchase.
Oh,
like it was
man.
just like not realistic. Maybe it was probably 400.
Actually, I have a
maybe.
property coming up around that price in Oshawa,
Hey, why don't we connect the dots? I'll send them an email.
right?
Yeah. Okay.
Believe it or not. No, I really believe it or not. But yeah, we'll talk about that off screen, offline.
Yeah. So, what are some of the other things that, like, I flowing into another question as well. Someone is buying pre-construction. They ask first, do they need to pre-qualify for a mortgage in order to purchase pre-construction?
Mm-hmm. It depends on the builder. Like the builder sometimes has a very tight requirements on what they want to see. They might want to see like a full mortgage approval.
Okay.
Which is a longer process. Like you want to make sure you're qualified. I find the branches actually do that a little bit better than the mortgage broker group does. As a mortgage broker, I can hold an interest rate for 120 days.
That's 3 months, yeah.
4
4
months.
months.
4 months, sorry.
Yeah. I'm like,
Terrible math.
wait a second. Am I saying
The
it
best
wrong?
part about it is that he's actually really good at math.
It's worse. But anyways,
Yeah,
so now you embarrassed me. So that you can hold it for only a limited amount of time.
So I can hold it for 120 days. Some builders will want it held until the closing date, and that could be 3-4 years out. It's just
Especially
not.
condos.
Yeah.
5 years, some
5 years.
Sometimes.
situations, right? So
So it depends on what the requirement is. Sometimes it's just like I write a letter and I've taken a look at their income, their credit, and I'm like, yeah, this makes sense. I can write a letter and that satisfies.
Gotcha.
And sometimes just a pre-approval from a lender will satisfy it. They don't need to hold the date or hold the rate until the closing date.
right.
So it depends on
The
that,
builder.
but yeah.
And just to touch on that, with the builder, it's not the builder actually. The builder is required. The lender that the builder is getting their financing from is required.
Is asking that.
Is asking for that. So just from what I thought it was the builder this whole time, and then I was in a seminar and they were talking about no.
That makes sense.
We don't care. You know what I mean? But we need it in order for us to get our loan, right? So for them to get their construction loan, the banks, a lot of these banks, depending on who they're with, are going to require for you to have a full blown. Commitment letter. No, joking.
Yeah, we're going to lend you $70
approval.
million for
Right.
this, right?
Yeah.
Right.
But you do whatever you want. Like that really doesn't make sense.
It was a lot more loose, I think, before, but they're getting tighter and tighter
yeah.
now. Yeah.
Yeah, so in the event that the builder does not need that requirement and they have a scope, let's say 2 years before their property is actually built and they need to close on it, what should they kind of like do to cross their T's and dot their I's? What should they be thinking about over that 2-year span to make sure that they're good to go for their mortgage?
Yeah, well, I think like we started the conversation with credit, right? Like
Right.
you want to make sure you're maintaining your credit. You're not going out and buying, a whole pile of things on credit. Like don't have multiple cars on credit and, try to clean up your debt commitments as much as you can. Maybe you've got some credit card debt that you're holding on to or a line of credit that you're holding on to. If you can pay those off as much as possible, that's going to make when the actual approval happens, because you will have to get approved closer to the closing date.
Right.
It's not just like, hey, 4 years ago I could buy this, but now I've got 2 other properties and like 3 car payments. You're all of a sudden not going to be able to qualify for that, right?
Right.
So
That's a good point.
having that, there's things that you can do in the middle, and 4 years is a long time, right? Pay off credit cards or, take on credit and pay it off. Like you can do all those things. But when it comes time, maybe it's just connecting with your favorite mortgage broker to talk about, okay, here's what I'm doing. Does this make sense? Am I still going to qualify? And over a 4-year period, people probably end up getting new jobs and making more money than what they initially did qualify for to begin with. So you can take on things for sure. But it's a long road, 4 years.
Yeah, sometimes.
Lots of change.
But
lots
so
of change.
yeah, so just just keep making sure your credit is the number is high,
Yeah.
the score is high, keeping your debts down,
Yeah.
and that you should be, and obviously keeping your job.
Keep your job. You want to be working, but having like your credit balances at 50% or less of your limit.
Got it.
Once it goes over 50% on a regular basis, it starts to look like you need that credit
You're
to
living off of it.
survive,
Yeah,
right?
yeah.
Like
Yeah.
I've got this credit, like my credit card's always maxed out. That's what actually sinks your credit score. So having high utilization and not paying on time, like don't get into a fight with Bell or whatever.
No, please.
You know,
You'll lose.
don't do that.
You will lose.
You lose every time.
Yes, every single
Leave
time.
Bell alone.
Yeah.
That's a good point. So just to touch on that. So you mentioned credit, down payment, income.
Mhm.
How does income play? Because there's like what pillars, 3 or 4 pillars, and when it comes to
Yeah.
getting the mortgage or qualifying.
Yeah, I mean that's a good question. I'm not sure how many pillars.
Yeah, how many? Just throwing pillars your way.
Just made up his old
What?
I
the
just made that
three
up.
pillars of qualified. What are you talking about, bro?
That's in the Tristian Clunis.
Oh yeah, what are the pillars, man?
qualifying
When you put
booklet.
my boy Sean on the spot with your
Take it away.
pillars,
Wes, help me out here,
with your made up pillars.
Take it away.
What are Tristan's made up pillars of
Talk to me about my
qualified?
pillars. That
Your pillars. No, but you're right. Income, credit, down payment are all the
There you
three
go,
things that
Wesley.
you're gonna want to.
yes.
Those are the things you're gonna want to make sure that you've got taken care of. So I think your income. If you're switching jobs, like are you on probation? Some lenders.
Right.
It doesn't matter. It's not an issue for them if you're on probation or not. If you've got a history of being employed in that realm, going to a new job for more money, it's not a big deal.
That won't cause any concerns.
No,
Got it.
and I mean, some lenders will just want more detail about it,
Right.
And they might want to talk to most of them want to talk to your employer anyway, but
Right.
just to verify what that means and if there's any like variable income. So I had this happens a lot. I'll have people take on a new job, and I often hear from people, "I found a new job. I'm ready to buy." Like that's like we're buying now, right?
Ready to go.
We're ready to go.
Yep.
And so, they get a new job, but a portion of their income is like on target, they will make 200,000, but your salary is $50,000. We can't use future income as what you qualify for. I need to use a 2-year average of what you made or your salary.
Right.
And so if your salary is $50,000, I'm like, oh, I'm going to make a ton of sales. I'm going to be like rolling in bonus or commission, and I'm
Right.
going to make 200,000. I need to see that on your taxes over a 2-year period. I can't just walk in and say, this guy's good. He's going to make 200. So that is often something that maybe people qualify thinking, or they tell the bank. I get this a lot. Oh, I didn't know. I just told the bank I make 100,000. And the person at the bank doesn't think to ask or
Nope.
doesn't do mortgages
yeah.
all the time.
Right.
And then they tell you that you can qualify for,
X amount.
$500,000
Yep.
mortgage or whatever.
Yeah.
But in reality, you qualify for 400. And so, a pre-approval or like a written qualification it depends, right? It depends on how accurate the information was that you gave to the lender
Yeah.
rather than what is actually real.
That's a good point, because that goes out to people who are self-employed.
Yep.
If you're under commission, if you have a low salary, as he said, but you have a big bonus, so you have big bonus, big commissions. If you're starting a new role that has that set up, they're gonna be requiring you to have a 2-year experience or 2-year.
Yeah.
Gotcha.
Self-employed,
Yep.
making, 2 years at least self-employed. And this is to qualify with the banks and the mortgage finance companies, in the A space. You can qualify for less, like as somebody who's self-employed. If you've been self-employed for less than 2 years, we can use bank statements to show, okay, here's the money that's coming in.
Right.
And it's called declared income.
Right.
And show like, okay, this is actually how much, this person is making, whether it's on their taxes or not, and then to be able to qualify you that way. So there are ways around it, but often find that, oh, I make a salary or on target earnings of way higher
Yeah.
is going to make a big difference in what they'd be able to qualify for.
In terms of job security, even if they were making the same amount, let's say they had been making 200,000 at their old job, but they're just getting a new job and they're only in it for a couple months. How does that security affect whether or not they'll be able to qualify for a mortgage if they've only been there for a short period of time?
Yeah, so but the being there for a short period of time is fine. Like
Okay.
you don't have to like be there for 3 months or anything like that. You can start. I can get you a mortgage based if you were on there a week. You know,
Okay.
some lenders,
Right.
but it's the variable of portion of your income
Yes.
that I need a longer history for.
They need track
Gotcha.
record.
Yeah, they need a track record for
Yep.
sure.
Cool.
One thing I want to
Go ahead.
that I know, I'm not sure if that's going to be one of the questions, but I want to just make sure we touch on it. Stress tests. we cannot,
Cannot do
we
it.
cannot end this or wrap this up without speaking
Yeah.
on the stress test. Obviously, just if you could start from the beginning,
Sure.
you know, back in, I think it was 2018, 2019, whenever they introduced it originally,
Yeah.
they changed it again, and then they're going to be changing it
Yeah. June 1st.
on June 1st.
June
So
1st it changes.
obviously,
Yeah.
I want you to just kind of just
Yeah, so
Explain that.
So I think I got in the business about 6 years ago. We were able to qualify people based on the interest rate that they paid. So
Right.
your payment that you make is the percentage of your income going towards paying the mortgage, tax, and heat. So we're getting a little bit granular here,
No,
but
no.
essentially, like now, and then they changed it to be at a higher interest rate. At that time, they were worried that interest rates were going to shoot up over 4%
Right.
over a 5-year period, and these people who had taken on these big mortgages wouldn't be able to qualify for as much money as what they could before.
right.
So they get to 5-year, they get to the 5-year point, and I can't afford my mortgage. So to combat that, they brought in a stress test where you would qualify at a higher interest rate than just the interest rate that you're paying. And so I think they brought it in. It was like 4.64% or something, 4.69. Like it was, and it's tied to the bank of the bank's their like rates or like their undiscounted rates, which are like high 4%. So when they brought that in, people qualified for less. And that was like a big jump. I think it was like 2016 or something, 2017 that it got
remember that.
brought in.
Yep,
and
I
like
remember it.
people were losing their minds. Like
Yep.
people are not going to be able to purchase homes anymore. And all the real estate agents are going to go home and not, be
Pretty
able to
much.
do anything, right?
Pretty much, yeah.
It was scary. And so they brought it, and then it moves around kind of more often than we think. But when it moves like it's moved now, so right now the qualifying rate is 4.79%. As of June 1st, it's going to be 5.25%,
right.
which is almost 50 basis points or like 0.5% higher.
Difference, yeah.
So it's the difference between people qualifying, like it's like 3, 4, 5% less, depending on how much income you make. But like say it's 4% less than
Right.
before. So there are people that are buying right at their maximum
For the
and
most part,
they're
almost everybody.
just getting into the market.
Yep.
I've got a client who, I've been working with her for I'd say like 3 years trying to get her ready. Like she's been paying down debt, she's been working more. Like we're using an average income. She works a ton of income, and she's looking at condos in like the
Wow. Yeah.
465, 470
Yeah.
range. She's worked so hard to get there. She's got one car, no other debt, one car payment, no other debt. And like it'd be the difference between her going from 475 to like below 460. And it's like there's just not a ton of
No.
inventory
Yeah.
at that mark.
It
Like
really
she's
starts to
just
dwindle down.
getting
Yep,
there,
yep.
right? So for her, she's I'm not sure what she's going to do. She has until June 1st really to use the old qualification rules.
Yeah.
But it is something that changes. Like
And
it
what
does-
needs to be in place? So if you're looking for a home right now,
Mhm.
you have today's the 27th of May.
We've got 4 days.
You have 4 days.
Yeah.
What needs to be in place in order for them to honor
Yeah.
the current stress
So
test?
you need to have a signed agreement of purchase and sale dated before June 1st. So May 31st backwards. And then we can use the existing or the old stress test rate of 4.79%. if it is you sign it June 1st, we're using 5.25%,
5.25,
and
which is
it's
now
just,
could be anywhere, as you said, anywhere from 3 to 4%, depending on your
Less,
purchase price and the whole nine.
for sure.
Less than what you could qualify
Yeah.
for before. Wow.
So it's a big
big
change
difference,
for
man.
So it's cutting off. It's I see where the government's coming from. They're trying to let's everybody calm down a little bit. Let's lower the demand that we have. It's a seller's market.
Listen,
right?
I'm a fan actually of the stress test, to be honest with you. I feel like, and I say that because obviously I understand that it does affect everybody, but the government's just trying to do what they could do in order to keep us from 2008 recession that the United States has. That's how I always envision it, right? Like it's kind of like, let's be proactive here so that we're not reactive. The States, they were reactive.
Yeah.
They got hammered. Canadians and what we're doing right now, they're trying to do what's necessary. And I think it's only going to be helping people because in a situation where if the rates start to hike, you should be good.
Yeah.
You know what I mean? Right now we're at 1.4, 1.5, I think 1%. Like the interest rates are extremely low. It's not going to stay like that.
It's never going to stay like
no,
that. No,
right?
no.
So they're going to increase, right?
Yeah.
So I mean, preparing people for that, I think that's only smart in my eyes, right?
Sure. No, I think
it sucks
you're
for
right.
clients, for my clients. I'm dealing with it as well.
Yeah.
But it's really preparing people for them not to default on their mortgage.
If we can, and I agree with that. I think that's exactly right. Like people will qualify for less, but if we can slow down the market a little bit,
Right.
prices are maybe going to slow. They're not going to go down, but if they can slow down, that's going to help more people, more first-time home buyers get into the market because the price won't be galloping out of control and it won't be
what's happening.
beyond what somebody can qualify for. So if we can keep it lower, that might get more people into the market rather
100%.
than yes, there are some people that will not qualify, but there are a lot of people that still do qualify that will take advantage of maybe a slightly less a slightly lower purchase price than they would if we didn't put that in.
Right. Awesome. So just to recap, we spoke about my 3 pillars to qualify for more. No, I'm joking.
I'm sure that's a thing.
I'm calling the Tristian Clunis. Wes, do you have a problem with that? I'm calling the Tristian Clunis 3 pillars to qualifying for a mortgage.
Sean, you're encouraging him. It's
Sean
not
said
a thing.
First pillar, down payment. You got to make sure that you have your down payment
numbered
in.
now?
Yeah. We're flowing with it right now. Down payment. Second, you're gonna have to have your income in place, and obviously we mentioned about a bunch of different different situations, variations to that. I'm adding my nice. Yeah, thank you. So income is second. Third is your credit. Making sure that you have to make sure I think about that. Oh, credit. We also spoke about the stress test. Wes, anything else that you want to touch on?
You know why I hate this, Sean?
He wants to be the captain.
I'm gonna
You need a hat.
I'm gonna have to create a whole graphic for this now. Tristian Clunis is pillars. He's gonna be standing on a pillar.
I'm gonna give you the graphic right here.
Can I use it when you're done?
Yeah. Sean's weighs 3 pillars to success in morttage approval.
I don't mind using it as the Tristan Clunis.
No, we're not using that.
Like,
We're replacing
it. Yeah. Take that, Wes.
Hey, man. How much time we got on that clock over there, man? Just tell me how much time we got.
About 52 minutes.
About 52 minutes? Yeah. You know what, brother? I think we're going to have to bring you back.
I'd love to go.
I would love to have
I think we're going to have to bring you back because...
your next questions are on investment, right? So we can
I have so many questions on investment. Let me see if let's try to do like a speed round here.
Ooh, rapid fire.
Are they yes/no questions?
Yeah, let's see. No, they're not. No,
D.
No, yes.
All the above.
They all have pillars. They all have several.
Don't worry, I will structure them for you. I will structure the pillars for you. Go ahead.
I'll just say
what I need.
I'm gonna ask you, Tris, in short, what are your pillars for finding if someone has to buy an older home? Which actually doesn't really make sense. They were saying if they had to buy an older home as a first-time buyer, that's all they can afford. But usually the older homes do have a little maturity as well, and they'll be a little bit more expensive, so that might not work out for them. But
depending on the neighborhood.
Let's just say, true. Let's just say, what should they look out for if they had to purchase a home that's like 10 to 15 years old? Is there anything that they should be super aware of in purchasing a home like that?
In terms of like the actual home, like the
things that they should think of.
So in this market, it's a lot harder to obviously get a house on the condition of financing and inspection, right? Mm-hmm. Like all these homes to get a house that's to get a signed agreement that states that yes, we're gonna accept this based on on the condition of financing and inspection. That's a lot harder. A lot of these deals are happening firm, which means that you don't have the option to go and get your financing. You don't have the option to get your inspection before you firm up on the deal. You usually have to have all that ready to go
In place, yeah.
before you even put your offer in. So I say that because, again, in a normal balanced market, we accept an offer. We have the inspector come in and they'll do a tour of the home. They'll go through the house with you. They'll give you a full inspection. They'll go through the roof. They'll see Sorry, they won't go through the roof.
That sounds bad.
That's a bad thing. Yeah, they won't go through the roof.
It's gonna be a crane. They're gonna jump.
Right? But they'll go through the whole process of a full report that's detailing everything you need to know about the house, even things that you probably will never do. They're going to make sure they detail it. What I tell my clients now to do is, because of the way things are, where everything is going multiple offers and firm, do that beforehand. Do a walkthrough with an inspector. So if you like this house, this is something that you're interested in, go right away. I'll get your agent to go in the second it goes up on the market. Take a look at it. You find that this is something that you like, go and do a walkthrough with an inspector.
Yeah.
Especially on the older homes. 15 years is actually not old at all, really.
Yeah, it's not really that bad.
That's not old. 15 years is like brand new in
My
real
house
estate.
is over 100 years old.
Right.
Really?
Yeah, that's right.
But we've
you're
renovated.
East York, right?
Yeah.
Yeah.
It's just the reality that
Yeah.
there's going to be houses that
mature.
old.
Yeah,
Yeah.
so 15 years is I consider
Brand
that
new.
actually a new home. Literally, really, I do. So like, let's say 50, 60 years old.
Yeah.
We're doing a walkthrough for sure. We're gonna have our inspector do a walkthrough on the second visit before the offer presentation date. We're going to be doing a full walkthrough so that you kind of what you're getting yourself into, essentially.
Yeah. Okay.
And if it's too much for you to handle, then you get out of it.
Yeah, and I'll say we are doing a first-time buyers seminar, so I'm going to ask you that question in a little bit more detail in that seminar. We'll be able to touch on a lot more things. I do want to ask you, Chris, this slide in this one investment question here. What are the pillars? Once again, this guy got these pillars sticking in my head.
I'm so happy. I'm so happy I got that in your
It's
head.
groundbreaking.
What are the main? What are the main points that you should kind of look for if you want to have a cash flow positive investment when you're looking for a property? What are the things that you can say? Okay, cool. These things are checked off. I should probably be cash flow positive.
Yeah, I mean the mortgage is going to be your big one, right? So if you can get your mortgage payment is somewhat controllable of like how much you're going to pay, but the relation to that is how much of a down payment do you have? Because the larger your down payment, the smaller the mortgage is going to be. If there's taxes on the property, like how much are the taxes? I was looking at kind of two similar properties, one in Scarborough and like Port Union, and then another one that was like just into Pickering. So obviously the land transfer taxes, like one was $10,000 in Pickering, and in Toronto that was $20,000.
And they're literally, you can walk over to Pickering from
They're not far.
Union. They're right
Not
there.
far, exactly. So that's one thing. But then the property taxes on the Pickering property was $5,000, and the Scarborough property was $2,400.
Yep.
Okay.
So it's like these properties that are seemingly crossing this imaginable
imaginary border.
imaginary line
Yep.
are totally different in terms of what the cash flow might be on that property.
Yeah.
Maybe you decide, okay, well, I'm more interested in just a lower month-to-month cost. So I'm going to pay the land transfer tax and take the $10,000 extra land transfer tax. I'm going to have the lower taxes. I'm going to have, similar maintenance fees, similar cost of upkeep. But really what you should be looking at is, yes, cash flow is important, but what is the likelihood that that property is going to increase in value? Because yes, you will make maybe a couple $100 or whatever a month from the rental income. But the real money happens with the appreciation of the property, equity that you're going to get out of it. If you hold it for 5 years, you, paid down the mortgage, but the value of the property has gone up way more than what your monthly cash flow is going to be.
Yeah.
So
Good.
Awesome.
Thank you. So yeah, I'm like
You're
I said,
out of
I got
questions?
no, I'm
No,
not.
you have way
I
more
have
questions.
way more. I
So
have a
what
ton
we're
of
gonna do
questions.
again.
We're gonna definitely have. I'm so happy you came, bro.
Yeah,
To have
that's
you
great.
here for the first one, to talk about, first-time buyers and the financing side is really a pillar. Sorry, I had to do it. It's a foundation, to get started in regards to when we have other guests. And we're going to have you on for sure to talk about investing and other things as well. Maybe even another first-time buyer session. Who knows?
Sure.
But I'm so happy you came, man. Appreciate
happy
you,
to
brother.
Be here.
Appreciate
you so much.
you.
Do I get a plaque or something?
Yeah, you know what? We're going to figure that out.
You
I'm going to
should,
get a pillar plaque for him. 3 pillars. But anyways, guys, I want to just say thank you so much for always watching. I know this is number 5 now. So we want you to subscribe. We want you to like. If you have any questions, please let us know. Leave them in the comments. We're going to have his information as well in the profile. I'm looking at Wes because Wes is probably going to be the one to do it.
Gotta edit some stuff in. He gives me editing work on the fly. No problem.
Figure it out.
I'll edit it.
But yes, I appreciate you guys watching this. Again, if you have any questions, ask Clunis on Instagram. Please give your Instagram as well.
Yeah, Sean H Mortgages at Instagram. That's the easiest way to find me. SEANH Mortgages. Yeah.
Perfect.
Cool.
Yeah.
That's on Instagram and on Facebook.
You can find me on Facebook same way.
What about you, brother?
West
Protege West Hype at.
No,
sorry, go ahead.
There's no protege. I'm the captain now at gmail.com.
That's not his name. That's not the tag.
No, West Hype on everything at West Hype.
And my name is Tristian Clunis, and it is at Tristian Clunis, TristianClunis. Thanks for watching, and remember, clueless, ask Clunis. Have a great day.